In a world where it feels like everything has already been done, there are still a few selective firsts. The first time man set foot on the moon. The first cloned goat, Dolly. The first telephone call. The first automobile. The first light bulb. The first time humans flew at Kitty Hawk with the Wright brothers. And the first time you heard auto-tune to T-Pain. In today's show, we are going to bring you a new first. The first time you buy a home and what you need to know. Welcome to Mortgage Mondays. All right, everybody, I'm here with Christian Batchelder, my partner and broker of The One Brokerage, talking about what you need to know about a loan when you're buying a house for the first time and what expenses you may have as you're moving into the house for the first time. This is an episode of first, so let me be the first to tell you that this is the first episode that you should think about if you're a first-time home buyer. Christian Batchelder, welcome to Mortgage Mondays. How are you today?
I'm doing good. Always good on a Monday where we're out here preaching the good word of the mortgage.
All right, so let's talk about primary residence and first-time home buyer fears, issues, concerns. What stops people from getting that first deal? Because most investors I know, once they've got a deal, they go on to buy more, and there's nothing wrong with your first investment or your first property being a primary residence.
But before we get into that, remember when you had to pay to get a lead's phone number? It was like the dark ages until DealMachine made skip tracing a thing of the past. Now, with your DealMachine plan, you get unlimited access to phone numbers and contact information for no extra cost. That's right. Get high quality, reliable information trusted by leading financial institutions, all fully compliant with the federal do not call list. Explore over 150 data points, including age, gender, marital status, occupation, and so much more. Trust me, this is the data you need for your off-market deals. With new filters, people flags, and color-coded phone numbers, lead management just got a whole lot easier. Ready to step up your investment game? Sign up for a DealMachine plan today and gain immediate access to this unlimited treasure trove of contact information and phone numbers. Just head over to DealMachine.com/BP. Transform your lead generation and deal-making strategies with DealMachine. Sign up today and start exploring the unlimited possibilities at DealMachine.com/BP, like BiggerPockets. Now, back to Mortgage Mondays.
So you've been in the game for a little bit. What have you seen as some of the big hurdles that stop people from buying houses? And then we're going to get into talking about some of the shocks that we had when we got into the game ourselves.
Yeah, 100%. I mean, I'm just having so many things rush through my mind, from your impound accounts to supplemental tax bills, and really just the fear. So many people get into analysis paralysis, even on their primary, right? When they're comparing renting versus buying and the cost of homeownership versus the cost of paying somebody else's mortgage with your rent. So David, I'd like to actually role reversal here. Let me ask you a question. Being the real estate celebrity that you are, what do you wish you could go back and advise yourself on when you bought your first house?
Oh boy, I was so angry at every little cost that I felt nobody told me. I looked at everything from this lens that I was being ripped off. So I just thought like the down payment was the only part you were going to have to pay money for. And then I get to the closing table and they're like, no, you have closing costs. And there's a lot of them. There's entire papers full of these things. So let me throw it back to you, Christian. What are some of the things that people need to be aware of if they're going to buy a property for themselves that they need to be prepared for spending?
This is by far and away the biggest callback that we get in the first year of somebody's mortgage, right? This bill came, this assessment came, whatever the case is, especially being we started this company in California, which we got some unique stuff that happens in California. So to answer your question, David, obviously the things that are rightfully disclosed on your loan estimate when you go to get the loan, your loan fees, the title escrow fees, that's usually not really the big surprise. In my experience, both personally and with clients, usually the surprises come around your impound accounts, which encompass your homeowner's insurance and your property taxes. A lot of people don't know you have to pay reserves on those. And a lot of lenders won't technically tell you that's a closing cost, because that's a bill you have to pay anyways. Whether you pay it now at closing or you pay it in 12 months when your property tax bill is due, it doesn't change the fact that it's still money collected from you today. And a lot of people overlook that. And David, when you were saying that you bought and your closing costs were more expensive, I would almost put money on the line and say it was most likely your California property taxes that was probably underquoted by whether it's a loan officer or a real estate agent. Right. The second part of that is in California. Now, obviously, do your due diligence with whatever state you're buying in. In states that I live in, that David lives in, there is also a supplemental property tax bill that is usually sent to you 6 months to a year after you buy. That is something that a lot of people don't expect. It's not collected with your regular property tax impound accounts. And that's a hugely misadvised concept with realtors, loan officers, even really, really experienced people. They don't tell you that you're going to be getting another bill in the mail on top of your mortgage. And if I knew that was going to happen, I would have saved accordingly and set it aside and made sure I was planning for it. And unfortunately, it was a surprise to me and many other first-time home buyers.
And what is a supplemental property tax bill?
When you buy a house, usually the tax basis resets to your assessed value. So the old owner, the seller of the house, was paying a certain percentage of property taxes. When you transact and now transfer the property into your name, you now pay usually a new percentage of property taxes. Okay. Now, some states you inherit the seller's property tax. This is a great thing to ask your agent who understands the market that you're investing in. In California, the property tax reassesses to your purchase price when you purchase. So more likely than not, what the old seller was paying is sometimes significantly less than what you're going to be paying in property taxes going forward. There's a difference. Okay. So if I'm paying $10,000 a year and the old owner was paying $5,000 a year, there's a $5,000 difference there. And it is prorated. So it may not be that flat $5,000, but it's prorated from the time the seller paid and when you pay. Now, this is a complicated concept, so let me break it down. When you take ownership of the property, you start your new property tax billing cycle. However, usually you don't close on the exact day property taxes are due. So there's not a clean break where it's the old bill into the new bill. Usually the seller has already paid the next 6 months of property taxes, and you're taking ownership in the middle of those months. There is a delta there. There's a margin between what they prepaid and what you owe for that time you owned the property. That is not calculated in your property tax bill. You're paying for the next 6 months. For example, if you close in January and taxes are due in April, you're paying from April for the next 6 months on your new impound accounts. But there's that delta between February and April of what you didn't pay. You get a nice little bill in the mail at the end of your billing cycle every year for that difference. Hey, this is what we collected from the seller. This is what you still owe based on your increased property tax. And I've seen these things, guys. I've seen supplemental property tax bills be $5,000, $10,000, even $15,000, depending on the purchase price of the property. They could be significant. And to a first-time home buyer that only put 3 or 5% down on your purchase, a $15,000 bill in the mail that you weren't prepped for could be devastating, right? That's a massive hit.
And don't expect anyone to feel bad for you, because that government employee that just wants to collect that check doesn't care. The HOA member who's like, oh, we're having assessments go out to all the owners. This is hitting me right now in Maui. 2 properties, they each are having to collect $56,000 for each one to go make repairs to plumbing and the roof and everything. And they didn't manage the reserve fund well, like HOAs rarely ever do. $108,000 that they're just like, oh, in the next 6 months, we need this money. And they don't feel bad. They don't care. They're not going to work with you on it. It's, hey, pay us this money or we put a lien on your property and then we'll just take it and sell it. And that's the game when you get into real estate. It's one of the reasons that we say you got to have reserves. You hear about how you make money in real estate. You don't always have people share about what you're going to spend money on. Now, you also are going to have to pay some money upfront sometimes for mortgage insurance, particularly on FHA loans, which are frequently put out there as the best loan to use for a first-time home buyer. What's that, Christian?
This is something that usually is so undereducated in this industry that when you get an FHA loan, you're putting 3.5% down. So that means your loan balance should be 100% minus 3.5. So you should have a 96.5% loan balance. That's never the case. FHA loans are actually closer to 98 to 98.5, which means you're only getting credit for putting 2% down. Well, why is that the case? That's because there's an upfront mortgage insurance. So it's happened so many times that people see their house appreciate a little bit, they pay down their loan and they want to come refi and they're calculating, oh, my loan, I put 3.5% down. Now I should have, whatever, 5, 10, 20% LTV on my equity. That usually isn't the case with FHA loans because there's an extra bit that was added onto your mortgage. Usually it's 1.8 to 2% of your loan balance, and it's not collected in a fee. So a lot of people say, oh, closing costs. Well, it's not, because the lender kind of sneaks it in there by financing it. So instead of just being a bill you pay at closing, it's added to your loan and you're actually paying interest on it. So it actually ends up being more than 1.8% because you're paying for the cost of borrowing.
You know what would be interesting if we looked at, let's say that it's an extra $12,000 or something. If you amortize that over 30 years, how much you'd actually be paying?
A lot more. That's the answer, right? It's not $12,000.
Yeah. I mean, you're probably talking about 6 figures that you're adding to this thing over a 30-year period of time. So
very possibly. Yeah.
all right, so let's wrap up. The fees involved in buying a house can be catastrophic if you're not ready for them emotionally. So there's going to be closing costs that you're going to pay to a lender, closing costs you're going to pay to title and escrow, insurance and taxes are going to be collected up front from you and put into an impound account, which we'll get into a little bit later. Your mortgage insurance that can be added to your loan balance, and then the cost of making the house move-in ready, which we will also get into in a little bit. Next, we have the costs associated in ownership. So it's not just the costs associated in acquisition, but you're going to pay money to be a home owner. What are some of those costs that people need to be ready for?
Yeah. Oh my gosh. Off the top of my head, this is close to my heart because I'm actually undergoing a project on one of my properties right now. Crazy. A lightning bolt hit my well pump. I don't know how that happens, but I have to repair that now, right? So that's the cost of maintenance is my first answer, David. That's anything from your fridge going out to your roof leaking to your foundation cracking, all the crazy catastrophic things that could happen, but also the minor things. Like what if your kid's playing around in the living room, throws a baseball and breaks your window? And that's not something that will ever go on a closing disclosure. That's nothing that will ever go on a loan estimate, but that's still money you have to have planned and set aside to cover those expenses. And just because your loan officer tells you you qualify for the loan with no reserves and we can, zero out your bank account to buy this house, that may be federally legal, but that doesn't mean it's good advice. As David said, reserves are everything in the game of real estate. Being able to withstand these troughs and peaks that happen in real estate are the name of the game. I think of the second thing, David, just like you just mentioned, raising HOA fees. That can just happen, right? If your HOA votes and says, hey, we got to paint the whole complex because the paint's peeling, they're going to take that $50,000 cost of painting a 100-unit complex and they're going to individually assess that to each unit owner. Like you mentioned, David, $56,000 per one of your units, probably assessed over a 5 or 10 year, whatever your terms are. Like that could be a $500 increase to your HOA every month, right? Do you have the reserve set aside or the cash flow from this property to be able to compensate for that? That's important, right? Because you can't predict that when you're closing. That's once again not on your closing disclosure. Obviously, your utilities. When we calculate your qualification for a home mortgage, we're not taking into account your water bill, your electricity bill, and you may have kids that run that up. Right? Are you taking baths every night? Are you, running the AC every day? Right? If you live in Arizona, AC is a high expense. The last one I can think of is obviously the not necessarily utilities, but like your landscaping, your pool guy, right? I mean, those could be hundreds of dollars a month that you're just not predicting when you buy the house because you're excited and anxious to become a new homeowner. And you're not realizing you almost have the cost of another mortgage to maintain this thing sometimes, right? So just make sure you're properly calculating these things. BiggerPockets has a lot of really cool calculators and estimators of what these services could potentially cost. Use them, right? They're here. They're built for you guys.
All right, so let's sum this up. You're going to have maintenance on your house, and if you're handy, you can cut down on that, but you're still going to have to put your time and you're going to have to pay for the parts. If you're not handy, that's going to be even more expensive. You've got HOA fees that will continually go up along with inflation. So if you buy into a house with an HOA or a condo, that's going to be an ever-growing expense. You've got water, sewer, and trash that now you're paying for, and you've also got things like cable, electrical, and landscaping to keep your house looking nice. And there's going to be times where the gutters are going to need to be cleaned out and roof shingles are going to be wearing off and pipes are going to start leaking and little children are going to color on your wall with crayons that maybe at one point you made the landlord deal with. Well, guess what? When you own the house, you get to deal with it. All right. We mentioned earlier, Christian, impound accounts. Can you explain what an impound account is?
Taxes and insurance are required to be paid when you have a mortgage. That's your property taxes and your homeowner's insurance. Both of those things have a very low likelihood of ever going down. Okay, property taxes historically don't go down, and insurance, as many of us know, is getting more and more expensive every year because houses keep burning down and there's continuous hurricanes in the southeast. So what that means is the impound account is the money that your lender collects from you to guarantee that your taxes and insurance get paid every month. So as we said in previous episodes, they collect 1/12, 1 month's worth of your property taxes and of your homeowner's insurance every month. They save that for 12 months and then go pay your bill at the end of the year. The thing that I wish I could advise myself on is in that year, if your insurance premium increases or if your property taxes increase, the lender did not collect enough. You will have what's called an escrow deficiency. You will have a negative balance impound account because the lender is still going to make sure that thing gets paid and they're actually going to pay it for you, then just bill you on top of your mortgage. So it's very frequently in borrowers' second, third, or fourth years of owning homes, they actually have their mortgage go up And it's not because they're on an adjustable rate mortgage. It's not because they got screwed on their loan product. It's because Allstate increased their homeowners insurance premium and they didn't tell the lender. So the lender was not collecting enough money to pay your insurance. So now they had to go pay the increased bill and charge it back to you in terms of your monthly mortgage. Nobody likes getting those escrow deficiency letters. I just got one for a home of mine in Florida. My mortgage is going up by $1,000. That sucks. I hate it. There's nothing I can do about it. I have set aside the proper reserves to make sure I can withstand that hit, as I advise everybody else to as well.
Thanks, insurance.
Yeah.
Okay, now let's talk about some ways that homeowners can save money. Now, so far, we've talked about all the things that suck about homeownership because we want you to be ready for them. But that's not the only thing that's going on. When you buy a house, especially if you house hack, but even if you don't, you set a ceiling on how high your mortgage can go. Now, as we just described, that could go up when your homeowner's insurance goes up, but your principal and interest will not if you set yourself up for a 30-year fixed rate loan. There's some other things you could do to save money. And one of them is keeping an eye out for rates to refinance when rates drop. Now, whatever you pay for the house is what you pay for the house, and your loan balance is your loan balance, but you can get that monthly payment lower if you can refinance. What should people look out for, Christian? What's your rule of thumb?
Obviously, I'm in the industry, so I have a rule of when I reach out to the client, but let me reverse that and say, when should you reach out to your loan officer? There's a lot of rate market trackers out there, right? You can follow the market, see what the average going interest rate is. Doesn't mean it's going to be your interest rate, but you can track it. Whenever you see those average rates get to around a 0.75 of an interest rate, so that's 0.75% to about 1.25%. So for instance, if you have a 6.25% rate on your home loan, if rates get to between 5.5 to 5, I would highly consider a refinance, right? Locking in that lower rate at almost 1% less is usually always going to be worth it if you intend to live in the home, 2-3+ years. You're going to save more money on your mortgage per month than it's going to cost to refinance. What I don't recommend you do is, my rates dropped by 0.25%, I should go refinance. No, the cost of the refinance are going to overwhelm any savings that you get there. That's not worth it. It's not enough of a rate decrease. Okay. But as David said, we live in a very, very beneficial financial situation in America where we can refinance and the bank can't refinance you. It's not like, all the people who have the 2.5% interest right now from COVID, it's not like the bank can come to you and say, you have to refinance at a 7%. They can't do that. It's illegal. But it's completely in our favor where if the inverse happens and we go back to 2.5%, everybody with a 7% mortgage can go refinance. So it's important that part of the responsibility of homeownership is being a good steward of your finances. And that means if there is an opportunity to save on your monthly mortgage just by making a phone call to your loan officer, make sure you have a contact in place that you trust, that you believe in their guidance, that you feel confident reaching out to and saying, hey guys, for my property, you already have my file from when you close this. What would the rates look like today if I refinanced? And as we go into what the prospective future is going to look like, these are more and more calls that should be made.
All right. And the last section for today is the move-in ready costs. What are some of the things that people should budget for when they buy a house and they want to move in?
If any of you guys listening are like me, where your first purchase was not your primary, right? My first purchase was actually an investment property. I can tell you're probably underestimating what it's going to cost to get that thing rent ready. I can almost guarantee it. You don't know what the current cost of furniture is, especially if you're like me and do short-term rentals. I underquoted myself what I thought it would take to furnish a 4-bedroom house. I was assuming much less than it actually costs, and I wasn't taking into account inflation and increased labor expenses and, all these expenses that go into furnishing a house, right? I underquoted what my appliances would cost, right? I wanted to redo the fridge because it had an old one, my washer dryer, so people can do their laundry on site, and just like the basic things like just cleaning the property, right? If you're buying a property that needs some work, what does it cost to get that thing shiny, right? Those would be my biggest things. That so many people only plot out for the number that's on their loan estimate. This is what it costs to get this thing. Well, I call them day 2 expenses. Those are day 1 expenses. That's day 1 of homeownership. Day 2 expenses are all these other things that are still money out of your pocket that have to be accounted for.
I bought my primary residence. I took a shower the first night there. I came downstairs to the kitchen because my bedroom is upstairs and there was a leak coming out of the ceiling. There was a plumbing leak the entire time that nobody saw during the home inspection that I got to fix. I bought other properties. We're dealing with one right now, an investment property that I'm getting ready to sell. I bought it not too long ago. It's a flip, put it on the market. Turns out it has termites. the entire time. If that was your house you're buying, you're now going to spend whatever it's going to cost to get that thing fumigated and get those termites taken care of. So it takes money to make money. Do not buy into this whole buying real estate with other people's money and no money down. There are ways you can limit your down payment on a home, yes, but you are not going to be able to eliminate all of the expenses associated with home ownership. All right, Christian, if people want to reach out and ask you more, where can they find you?
Absolutely. As always, guys, on Instagram, @the1broker is my handle. As David said a couple times, there are a lot of fake accounts. I am at @the1broker, not at the one broker 1 or 2 or 3. I don't invest in crypto. I just got an email today. I don't invest in crypto. I will never ask you to. And David, I know you don't either. Where can we find you?
That's right. You can find me at davidgreen24.com or at davidgreen24 on your favorite social media. Give me a follow and send me a message and let me know what you thought about today's show. Also, if you like today's show, go into the comments right now and type in what questions that you have for first-time homeowners or primary residence buyers that are often, frankly, not covered in the BiggerPockets universe nearly enough, and let us know what you would like to know or what you think we didn't cover. This is your chance to say, hey, I've always wanted to know this thing. Can you guys make a video that talks about it and explain what I should know in these cases or how you handle these kind of problems? Because we at BP are here for you. All right, everybody, if you got a minute, check out another BiggerPockets video. And if not, we will see you next week on Mortgage Mondays.